See on Facebook, Twitter, Instagram, and YouTube by searching 1450 WCTC. And now, back to Jersey's Morning Show, Jersey Central with Bert Barron.
It's 8:37. We're back on Jersey Central on the new Talk Radio WCTC, the voice of Central Jersey. We're inside the Forge Jewelers Studios today. I am Bert Barron. Welcome. Good to have you here. Need to know things are straight ahead. Hopefully you're a WCTC weekend listener. We have a great program for you. With our friends from Regal Financial. And joining me now on the Jersey Central Newsmaker Hotline, let's say hello to Randy Fisher, who is with us here to talk about this Dow 20K, this significance of the Dow Jones reaching that 20,000 plateau, and some other things that are normally covered in their weekend radio show here on WCTC. Randy, it's Bert Barron. Good morning. How are you?
Good morning, Bert. How are you doing?
I'm good, man. Good to talk to you. And what I think I like the best about your weekend show, Randy, is I'm not real big on financial things and real heavy things that you guys cover. But for a guy like me, I understand everything you guys are talking about. And it's such a relatable way that you guys convey the information every week. And that's why I think your show is so popular. So kudos to you guys for the great program you do here every weekend. I really appreciate that.
Thank you. I appreciate that.
So the Dow 20K, what do we need to know? Is this some rainbow unicorns and happy things, or what's going to happen next? Should we be excited about this 20K number?
You know, it's a big mark. We hit it finally. I think it was more sentimental value than anything. You know, changing into guard and looking positively towards a new presidency or what was going to be happening. But since we've kind of hit that number, we've been trending backwards a little bit. You know, we got an hour and a half or an hour to until we open the market today, and maybe we'll get over the 20,000 number again. But you know, it's going to bounce back and forth. You got a lot of things that are going on. There are some yellow flags out there. You've got some yields that are looking differently. You've got some cash that mutual fund holders or mutual fund managers are kind of stockpiling. And when things like that happen, it's getting a little defensive. So while it's optimistic that we've hit the 20,000 number, we could be sitting on a little bit of a pullback coming shortly. And you and I know this. Markets go up and markets go down. You know, if you're in it for the long haul, then you've got nothing really to worry about. But I think if you're embarking on retirement within the next, 18 months or 2 years, I think you need to take a cautious approach.
What is the Dow Jones really a litmus test of, Randy? What is that really an indicator of?
It's really only 30 stocks when you really think about it. It's like I said, it's more sentimental than anything. It's not what it used to be. These days the Dow is more or less just in the newspaper or in the news all the time, and people actually have a false sense of understanding. Many people's portfolios aren't even indicative of the 30 stocks that are just in the Dow. Most people are so far diversified from those 30 stocks, they think that their results are, daily, it's their daily scorecard, and it really isn't. A lot of times you have people that are kind of being very, very emotional about their portfolio based on the news of what happens during the course of trading days. And that's really not what they need to do. They need to take a broader approach to what their individual portfolio looks like, as well as they probably need to take a more realistic approach to what their portfolio looks like. Because if they only had 30 stocks, that's a pretty concentrated portfolio. As big as those are, they're probably not going to get you to where you want to be.
Gotcha. How does that compare to the Nasdaq? I know people have heard that term for a number of years too. Randy, is the Nasdaq is it kind of the next generation of the Dow, or what's the dynamic between the two?
Not so much. I mean, it's a more broader approach. It's more into more technology funded companies. Again, a broad range of a portfolio is probably the best bet. When you take a look at history, a lot of people don't realize this, but it's the small company and the emerging company stocks that actually have a better push on your portfolio over time and give you a better return. You know, the ones that give you the warm and fuzzy feelings are the ones that we know of every day. You know, those big companies, Microsoft, Exxon, Yahoo, things of those nature. But it's a more well-diversified portfolio that's probably going to put you where you need to be, as well as having all your eggs in one basket is probably not a smart move. You know, everybody talks about being diversified, but even diversification, it does not stop you from losing money. So you have to have a proper plan in order, so you're not trying to put a round peg in a square hole.
And I guess the same rules still apply about, depending upon what your age is, what your family situation is, what your income levels are. It's really different for everybody, depending upon the stage of your life, right, Randy? That still holds true?
Yeah, absolutely, Bert. My co-host says it all the time on the weekly show. Everybody's situation is different, and you've got to look at it as an individual approach. And I firmly believe that because, what my risk tolerance is in perception is different than your risk tolerance in perception. Doing this for over 2 decades plus, I've come across people who are in their mid-80s, and they have a risk tolerance that's far beyond what a 30-year-old would have. And then you ask someone who's 35 years old or 40 years old, what's their risk tolerance, and they think CDs are too risky. So, it really depends on what someone's individual perception is, what their time horizon is, what their value is, what their nest egg looks like. So everybody's situation is going to be entirely different. I think everybody needs to take a look at that and take an individual approach because, just by taking rules of thumb, they're okay to start with, but it's not something that you want to just draw down on and say, that's where I'm going. That's where I have to stick to. I think everybody has to take their own approach to their own investing, whether it be in your 401k, whether it be in if you're laddering CDs. So it really means, what type of risk are you associating with yourself to your account? And it's not what what your tolerance is, because if you really think of the word tolerance, look up the definition. It's not a pretty good one. It really has to do with what you're willing to part with. And when you ask that question, a lot of people are really not willing to part with a lot of their nest egg anymore. They don't want to go through another 2000 to 2003. They certainly don't want to go through another 2007 and 8. So I think they're taking a more defensive approach to their future, which is good. You need to be cautiously optimistic. But if you're in it for the long haul, then you've got some opportunities. But if you're in it for a short haul, I would say 3 to 5 years or less, I think you need to do a good evaluation of your situation and make sure you're in the right spots.
Is the start of the new year, Randy, a good benchmark to maybe take a look at your financial situation? Do you wait till you get through the tax season, which is coming up in the spring? When is a good time for somebody to review all this?
Great questions. My wife sends me to the doctor every January for, a checkup. I think everybody needs to do the same thing with their finances. You got to do a financial checkup once in a while because it actually gives you a starting point, right? You got to figure out where you are to comparative to where you want to go. Tax planning is another good point that you just brought up, Bert. That's not an April 15th thing. It's a year-round 365-day plan. And if you're looking at taxes from a good angle, what you want to make sure is that you're taking advantage of the entire year to get those breaks, especially with the new administration that's coming in here. We don't really know exactly what's going on. They're saying that they're going to be cutting some taxes, but cutting taxes and eliminating deductions or exemptions and things of that nature is going to really change the tax code around. So I would actually say this. In 2017, it would be a very, very good idea to either get together with your financial planner or find a financial planner that understands the tax code and how that's actually going to affect you both positively and negatively going forward.
Yeah, good stuff. And every March, by the way, should I make the doctor's appointment for you or will you do your own? Yeah, March is my month for that one there. But like you had mentioned, I guess the only certainty is uncertainty as we move into this new administration. And you know what? It seems like more than ever, Randy, information is king and knowledge is really is king, is what wins the day here even.
It is true. I mean, you have to really take a look at it. I mean, we've gone through these changes throughout the course of time. And the markets are going to go up and the markets are going to go down. There's absolutely no doubt about that. And you're right. Change seems to be the only thing that's constant. But there are things that you can do to tip the scales in your favor. If you take a look at it from a realistic standpoint, as of March 9th, if we make it to that point, we're going to be in a 8-year bull market cycle. That means that the market was up 8 years straight, which is just absolutely unbelievable when you take that into consideration when the average bull market lasts only about 43 months. We've been through a tremendous expansion, but that's because money was cheap, stimulus was high, taxes are relatively low comparative to historical rates. So we've got a lot of things going for us there. So if we do take a pause or we hit a little bit of a rocky road, not only is it healthy for the market because we normally go on to the next best thing, but we do need that little correction, as we say, because there's other things that are out there that just aren't looking correct right now. I mean, just take for instance, the economic growth in America, GDP. It is painful when you actually take a look at it, and it's been slowing not since the 1990s or 2000s, but it's been slowing since the 1970s. We've fallen from a 4% gross domestic product growth rate to almost less than 2%. That's pathetic. And we're looking at it as well. How is the market actually progressing forward when the economy's not really doing well? There are a lot of false things that are in there that are making this thing work. Give you a context. During the Great Depression, the GDP actually grew 0.34%. During the last economic cycle since 2012, our economic growth has only averaged 0.147. That's twice as much in the Great Depression than where we are today.
That's pretty remarkable. Randy, I know that you give the number out for more information during your weekend show here on WCTC. Someone listening today that might want to reach out and talk to you about learning more, how do they go about it?
Sure. You can find me on the web, regalfinancialgroup.com. Or you can also call our hotline, 888-636-1918. That'll get you right to our staff, and you can ask any question, or we can get any information out to you.
Excellent. Really appreciate it, Randy. Thanks for your time this morning, and we'll be listening to your show this weekend at WCTC, all right?
Anytime, Bert. Talk to you soon.
All right, you bet. Thank you. All right, Randy Fisher, my guest on the Jersey Central